Everybody, and welcome to Safe Option Strategies. My name is Jeffrey Dunyan. Glad you joined us for our presentation about turning the tables on a rigged stock market. Let me tell you why I did something very different than what I've done in the past. In the past, the free presentation that kind of introduces you to Safe Option Strategies is usually focused around strategies that help you beat the market and how to trade with little or zero risk. But I know a lot of people feel lately like the stock market is rigged. I've had a number of conversations with individuals who really think that no matter what they learn, no matter what education they get, no matter what they pay for, no matter what they find free, they feel like the market is rigged against them, and that unless they're part of some big, powerful hedge fund, or they find a way to get their, $30 or $40 or $50,000 into some type of a secret fund that not very many people have access to, they just feel like it's too difficult to beat the stock market. That no matter what they do, something's going to turn, something's going to happen, something's going to change, and they're always going to be on the short end of it. It's understandable, but if you think about it, it's a really cynical attitude to have when you think that every trade that's placed has to have a winner and loser. That's not actually the case. There are companies that want to sell at certain prices that will benefit them, and buying at that price can benefit you. And there are people that want to do the opposite of that. And so it's not this automatic that every time someone buys and someone sells, there has to be someone on the losing side. But it feels that way. And it feels oftentimes like the odds are very much stacked against us. So I'm going to take a few minutes and talk about how you can actually change those odds, how you can turn it to be in your favor. Once you learn a couple of secrets about trading, once you learn a couple of strategies that are very unique and very different from probably a lot of what you've been exposed to up to this point in time, you're going to realize that it no longer matters what happens with the trades that other people are placing. It no longer matters what happens when a broker or a market maker raises a price high on something to trigger you out of a trade, or they move the price low on something to trigger you out of a trade, because there are a couple of different trades that you can be in on a regular basis that make it irrelevant. How would it be to have a trade in place that no matter what the market makers decided to do, no matter what the big brokers did, and the big money, as we like to say it, if you could see me, I'm making little air quotes, the big money, no matter what they do, you can be on the winning side of it. And I'm going to give you a glimpse into that, a couple of different types of trades that can literally change the game for you. Let's start with this first one. Why is it so hard to beat the markets? That should be a question mark for sure. Big question mark there. Why does it feel like it's so hard to beat the markets? Well, it's not because of things like this. See, a lot of people want to look to what happened earlier this year, and they want to blame everything that went wrong with their portfolio on something like this. I'm here to tell you, this move affected everyone. The brokers didn't have an advantage. The market makers didn't have an advantage. The hedge fund managers didn't have an advantage. The big companies like the Goldman Sachs and the JP Morgans, they didn't have an advantage. This affected everyone. This is a black swan event. This is something that catches all of us off guard. We can't see this coming. And the people that claim they saw it coming, there's a company that was running a radio. It finally disappeared here this past week or two. For about 6 or 7 weeks, I heard this same advertisement being run on TV and on radio over and over and over again about this company that sells some really expensive software that is supposed to help you predict when the markets are going up and when they're going down. And this company claimed in this advertisement that they're the only people who predicted this was going to happen. And they claimed that they saw it coming about a month before it happened. And if only you would have had their expensive software, and if only you would have followed what they were teaching, you would have been spared from this, and you would have known. Well, I got news for you. This company has predicted this type of a drop on average 3 to 4 times every year since 2008. Remember when the market sold off a lot more than 35%? I think the three major indexes were down over 50% back in 2008. Maybe you were in the market, maybe you weren't back then. But every year since then, on average, 3 to 4 times a year, they have predicted that we were a month or two away from a 35% drop. So if you would have paid $10,000, $15,000 for their really expensive software, I think their entry-level software is around $5,000. But if you had paid, you know, the $10,000 or $15,000 for all their bells and whistles and their big software package to help you predict this, you would have been right. Problem is, you would have been wrong about 20 to 30 times prior to that, and it would have cost you a lot of money. So this is the type of thing that catches us all off guard. This is not what frustrates people in the market. The reason for that is this: the markets are always going to correct as long as there is still underlying growth in the economy. Now, we can have a recession for a couple of months, for even a year or so, but in the long run, if the underlying economy is growing, and let's face it, we've got a growing economy. It hit a major stumbling block a few months ago, but we still have some good, solid fundamentals in our economy, and that's causing it to grow. And the markets are always going to correct. They're always going to come back as long as there's some underlying strength to the economy. So it's not this move right here that really stacks the market against you. It's not moves like this, obviously, that stack the market against you. What makes it so difficult for people are things like this. You remember back about 4 weeks ago, 5 weeks ago, there was one day that the Dow Jones Industrial Average sold off 18,000 points, or excuse me, I'm sorry, 1,800 points. Let's make sure I don't get that wrong. The Dow Jones Industrial Average sold off 1,800 points in a single day. Now that is the type of thing that makes you feel like the markets are rigged against you, because there are computer algorithms causing those moves. There are pre-programmed trades put in place that are causing those moves. There are panic buttons. There are things going on behind the scenes that you and I, as everyday investors and traders, we can't control. And these are the type of things that will absolutely sting you when you're doing everything right, when you're putting together smart trades, when you're doing your homework, you're calculating what the risk and reward is, you get your stop losses in place, you feel like you've got everything set up exactly right, and this type of move will absolutely sting you when it happens. Just today, at the time of our recording of this, we've got the Dow Jones Industrial Average at one point in time, I think it was up 600 points today. And you know what's driving it? You know what's driving the market up today? Nothing. There's nothing going on. There's nothing that changed fundamentally in the economy. There's nothing that changed fundamentally in the types of things that should affect the markets. Our GDP didn't suddenly change. Our employment and unemployment rates didn't suddenly change. We didn't suddenly have a consumer confidence index that went through the roof. The markets are just going up like crazy, and what's happening is, behind the scenes, a lot of trades are being cleared out. A lot of people that have been doing trades thinking that this would stay flat for a little while longer are getting pretty severely burned right now. Now, I said that the markets were up over 500 and some odd points. That was when there was about 1 hour left to trade in the day. Before the trading closed out at the end of the day, all 500 of those points had been lost, and the Dow Jones, the NASDAQ, and the S&P were actually in the negative. And they were in the negative pretty severely. Can you believe that? I mean, just today, the day that we're recording this, we've seen things turn around and go the other direction in almost an unbelievable way. And it came on one primary piece of news, and that being that the state of California announced that they were going to completely close all indoor restaurants because of the spike up in coronavirus cases. So even on a day when everything seemed like it was going your way, midway through the day or 3/4 of the way through the day, we get this sudden reversal. Now, if this type of thing doesn't make you feel like the markets are rigged against you, no matter what you're doing, you feel like you're playing a losing game. If this doesn't do it, I'm not sure what will. But I tell you, there is a way you can beat it. And I'm going to give you some insight into a couple of different ways that you can absolutely turn this around and absolutely beat it. The question is, can the odds be turned to your favor? I want you to look at our trading record from the first of the year to right now. Now, I want you to keep in mind that two of the major indexes, as I show you this, keep in mind that two of the major indexes right now are still trading in the red. Okay, the Dow Jones Industrial Average is still down on the year, and the S&P 500 is still down on the year. Only the NASDAQ is in positive territory. From January 1 until now, this is the culmination of trades that we have sent out to our students. These are the type of trades that we teach. These are the type of trades that are going to change these odds and shift everything to where a rigged market is no longer going to feel like it's rigged against you. These are actually trades we lost money on, and they don't matter. These ones in the yellow are the trades that are still open, but they show the net profit or loss that we would have on them if we were to close them out right now today. Folks, we're only a little over halfway through the year right now, and we are up 73%. When the Dow Jones and the S&P are still negative, and the NASDAQ's actually having a pretty solid year. If it ended right now where it's at today, that'd be the fourth best year out of the last 8 or 9. But we're up 73% right now. And it's primarily due to a couple of game-changing trades that will shift everything back to your favor. Okay? Here's a 6-month chart of the Dow Jones Industrial Average. Now, there are a lot of strategies that we teach at Safe Option Strategies. There are a lot of different things that we can teach you to do. And one of the primary things we teach you is how to adjust trades that are going against you. There are some other videos on our website that go into a little more detail, free videos on our website that go into a little bit more detail about adjusting trades. I am going to focus for just a minute on one specific type of trade because it is one of the easiest, most high probability trades you're ever going to place. And it's called a long iron condor. Now, this is one example. This is not everything we teach, but it's one example. A very popular trade. Now, if you're new to options, okay, if you're new to options, you may not know what what an iron condor is. It has a very cool name to it. It's got we say that this trade has curb appeal. It sounds cool. It sounds sexy. It's a great trade to be in. Iron condors are oftentimes taught to people as a great income strategy. And the reason iron condors are taught as a great income strategy is because you're actually being paid some money to be in the trade. Okay, think about that. Instead of you spending money to be in a trade, you're actually being paid some money to be in a trade. And the way an iron condor works is you set up a short call that's a little bit out of the money, trading higher than the price of the stock, and you set up a long call a little bit higher than the short call. And this is a very popular spread called a bear call spread. And then at the same time, you get a short put that's out of the money and a long put that's even farther out of the money. And the object of this, if you don't understand the trade, if you've never been taught this trade, that's okay. The object of this trade is that you get paid some money up front to be in this trade. And all you need to be profitable is for this stock to end up somewhere in between the strike price of your short call and the strike price of your short put. And so you set your short call up here and you set your short put down here. And if this stock just keeps on kind of moving in this range and you get to the day that these options all expire and you're somewhere in between here and you're somewhere in between here, you're profitable in the trade. And it's a great trade. I like this trade, but I'll tell you the number one problem with this trade. It is a very difficult trade to adjust. If this trade goes against you and suddenly the price of the stock goes above your short call strike price, or suddenly the price of the stock goes below your short put strike price, there's almost no way to win. And instead of having a really nice credit per share that's paid to you, you end up losing sometimes more than 100% of what you could have gained, because this would be your max loss in this case. Imagine if you had placed this trade. Let me back up my screen just a little bit. Imagine if you had placed this trade right back here, thinking that we were going to stay in this range for a little while, and then all of a sudden, in a fairly short period of time, we had this thing climb. And right in here, you're in trouble. Instead of making a really phenomenal percentage return, you've lost 100% on that investment. This happens all the time with people doing iron condors. By contrast, let me show you one simple thing you can do that changes the odds to your favor. See, the problem with this trade, the reason the odds are against you and the reason it feels like the system is rigged against you in a trade like this is because when you get down to these last few days before the expiration of this option, a market maker, if they choose to, they can suddenly fill a couple orders up at this price, even if the stock price finishes down here. They could fill some orders down at this price, even if the stock price finishes somewhere in here. You could have the price finish during the day, right in between those two prices that you need, but there is nothing at all that prevents a market maker from going up and filling an order way up here or way down here that would absolutely burn you in this trade. And it happens on a regular basis, 1, 2, 3 days before the expiration of these options. Right when you think you're going to make a nice profit on the trade, you suddenly get stung. This is one of the reasons so many people, in fact, feel like it's rigged against them and feel like they can't win no matter what they do. They picked a good trade. They had a great risk to reward ratio. And all of a sudden that thing just turns so severely against them. Now, there's a slight variation of this trade that I'm a big fan of. We switched the place of the short call and the long call. And then we switched the place of the short put and the long put. And what we end up with is something called a long iron condor. And here's the thing with the long iron condor. We might not make as much profit overall if the trade goes our way, but in today's volatile market, I would tell you that there's less of a chance that a stock or one of the indexes stays in a tight range like this, and more of a chance that it goes up or that it goes down. You don't have to look at very many stock charts. You don't have to do very much research to know that things don't stay flat for very long. They have a tendency to really move up or really move down strong. And in this case, it doesn't matter whether it moves to the upside. It doesn't matter whether it moves to the downside. Either direction, and you have an incredible high probability of winning on that trade. When you buy a stock or when you buy an option, what are the three things that the stock can do? The stock price can go up, the stock price can go down, or the stock price can go sideways. Now, it can go up really fast, or it can go up kind of slow, or it can go down really fast or down kind of slow. But you basically have three different directions the price of that stock can go. It can go up, it can go down, it can go sideways. If you're playing trades that need it to go sideways, there's only a 1 in 3 chance you're going to be right. If you're playing a trade that can profit from a move up or a move down, you've just flipped those odds in your favor, and you're playing a trade now that 2 out of 3 times can be right. Every once in a while, we get a stock that gives us a really flat pattern for a period of time. But if we know the history of the company, we should know that every time we get a flat pattern for anything more than a few weeks, we get a pretty big move up or down. Every time we get a flat pattern, we get a pretty big move up or down. Instead of trying to predict how long this might last, once you've got a pattern where it's happened for 2 or 3 weeks, you go out just a little ways in time and you set up that trade. And instead of being in that iron condor trade, you switch the long call and the short call, you switch the long call or the long put and the short put, and you end up in a long condor. And oftentimes you can find trades like this that will make you almost as much profit as the iron condor with far less risk, and most important, easy to adjust. Adjusting a trade is when you can actually sort of turn the direction of the trade to match the direction of the stock. That's really hard to do with most credit spreads. It's far easier to do with debit spreads. And the proof is in the pudding, folks. These are all long iron condors that we did when the markets were a little too volatile to try and predict. In many cases, they weren't really highly profitable trades. This one was adjusted and only got us back to a break even, but we didn't lose money on it. They're very, very high probability trades. Even when they're not real highly profitable, they're very high probability trades. They're fantastic trades to be in, and they can turn the odds in your favor. Now, I don't have time to show it in this presentation, but another trade that we love to teach here, and you can see a lot of them on our list here, are in-the-money bull call spreads. And these ones, generally speaking, have the ability to be a lot more profitable. We got a 55% return on this trade, got a 51% return, because this is what happens to people over and over again. They place a trade. They make a nice little profit on the trade. They take that profit, they add it to what they started with, so their next trade is their profit plus their principal. And then they repeat that and they do it again, and then they repeat that and do it again. And then the one trade comes along and they were wrong. And that thing turned on them, and this is more, what's the way I'm trying to say this? This is easier to be at a sudden instant loss like this when you're trading options. And all of a sudden, 75%, 1, 2, 3 out of 4, 75% went exactly the way you wanted them to go, but you're sitting at a 13% loss. Learning how to adjust trades. You get the same scenario, but here's the difference. Because it was set up correctly and because you knew how to make an adjustment and when to make an adjustment, even if you didn't make profit on it, you just got it back to a 0 loss or a very small loss, and the difference is staggering. Instead of being down 13%, these same 4 trades are up almost 60%. How to trade with 0 risk, all right? Trading with 0 risk involves stock and options used in conjunction with each other. We're going to own some shares of stock, and we're going to use a long put option like an insurance policy. Now, if you want to pause and read through all of this, go ahead and read through all of this. The long put option can be used almost exactly like an insurance policy is. If we buy a stock, we have 100% of that at risk. If we went out and bought a stock for $100 a share, 100% of that is at risk. Theoretically, that stock could go all the way down to 0. If we buy a long put at the strike price closest to where our stock is, we are protected from any loss below that. We're going to pay a premium, just like with an insurance policy. And if the stock goes down, our long put simultaneously goes up in value. Think about an insurance policy. You go out and buy a Tesla automobile. I think the Tesla Model X sells for $85,000 or $90,000. I don't know if that's with all the bells and whistles, but I think a stripped down model Tesla comes with a lot of bells and whistles. So you go out and buy a Tesla. I guarantee whether you pay cash for that car or whether you finance it and the bank is holding the title, you're going to get insurance for that car, because you're not going to let an $85,000 car get dinged by someone who then drives away and leaves you hanging, you're going to have insurance on it. You're going to pay a premium for that insurance. It's going to cover the car at a certain price. It's going to cover it for a certain period of time. And when that time expires, you renew the insurance policy. Most of this is done for us automatically through our insurance companies. That's fine. But it works almost the same way. You go out and buy a stock. You buy a long put option that expires after a certain amount of time. You pay a premium for it. And if something happens to your car, I mean your stock, you're covered. You've got an insurance policy on it. Okay? Using a long put option as an insurance policy and then adding a covered call. Now, I'm not going to take time in this presentation to explain to you what a covered call is. You get a credit for writing a short call with your stock. Most of you probably know how to do that. If not, I promise you it's part of what we teach in the program. Okay? When you combine your stock, your long put, and your short call, you have a trade referred to as a collar trade. Okay? And collar trades can be set up for zero risk. Snap is the ticker symbol for the company Snap Incorporated that owns Snapchat, the very popular and becoming more and more popular social media program. All of my kids use Snapchat. I've got 4 kids. One of them is a teenager. The other 3 are adults. They all use Snapchat. All their friends use Snapchat. So guess what? If my wife and I want to have much contact with our kids, we've had to learn to use Snapchat a little bit. If I went out and bought 100 shares of Snapchat right now today, I would pay somewhere in the neighborhood of $26.45 a share. If I wanted to protect myself from any possible loss in this position, I could get a $26.50 strike price long put. That's the price at which I have the right to sell my stock, and that's going to cost me $2.52. But then I can go out and sell a 30 strike short call that pays me $2.92. And the net result of all of that is a total cost of $26.05. I probably don't need to put on these marks because I think I've got the automatic ones coming in here. From now until the time my option expires, I have zero risk in this position because my total cost to be in the position is $26.05. And I have an insurance policy that lets me sell everything at $26.50. There is no possible way that I can lose money on this trade before the expiration of that long put. Just like with my insurance policy, if I get to that expiration date, I may have to renew it and get a new policy. Do you know why I set this up to go to August 7th? Because on July 21st, Snapchat reports their earnings. And all I want to do is make sure I'm very well protected for a couple of weeks past their earnings report in case their numbers are bad and they go way down. Guess what? JP Morgan, JPM, ticker symbol for JP Morgan Chase, they report their earnings next week. I could get into shares of JP Morgan and have zero risk in that trade until I find out what happens following their earnings report, and then I can decide what to do after that. Bank of America reports next week. Stock's only $23.11 right now. I can have it protected at 23 with a long put and have my total cost be only $22.95, zero risk. Netflix, there's an expensive stock for you. Not like Amazon, but still a pretty good price stock. Trading at $504.99 right now. I can protect it at $505 and have a total cost less than that and have zero risk. And guess what? They report their earnings next week. Do you see a pattern forming here? Okay, it is easy, and I can teach you how to do it. It is easy to set up trades that have zero risk in them. And you can still build them to where they have a little bit of profit in them. But let me show you where the real profit comes. Have you heard of something called cost averaging or dollar cost averaging? A lot of people do this. They buy a stock. The price of the stock goes down. They buy another share of stock at that lower price. Price of the stock keeps going down. They buy another share at that lower price. And now they have one share at $100 and one share at $70 and one share at $50. And if my math is correct, I believe that would be a total of $220 now that they have. One at 100, one at 70, one at 50, $220. And you divide $220, divide it by those 3 shares, and the average price per share is $73.33. Now, this is a great way to trade, and it works very well, and I would never, ever recommend to anyone that they don't do this if they have the money. But do you know what the flaw is in that strategy? Do you know what makes that really hard? What if I'm doing this times 10 shares or 100 shares? Now I've got 10,000, and to make that work, I've got to come up with another $7,000 for those next 100 shares. And then I've got to come up with another $5,000 for those next 100 shares. And the problem is, in the process of trying to dollar cost average down, you could run out of money. And people often do. When you add in that long put and short call option, when that stock goes down and the value of your long put goes up, you sell the long put and you use the money you bring in right here to add shares of stock to your position. So you're adding shares at no added investment. Think about that scenario I just went through. You buy some shares at 100, you buy some more shares at 70, you buy some more shares at 50. What if those shares at 70 and those shares at 50 didn't cost you anything? Because you had money from long puts that were paying for them. Now, when the stock begins to go back up, you don't have to get back up here to $73.33. You're profitable at $50 and a penny, or at $51 you're profitable. And if that stock ever gets back up to 100 where you originally bought it, you're profitable by a really big, huge margin. Now let me show you. I've got less than 10 minutes left. Let me show you exactly how this works. Student of mine a few years ago, 3 years and 3 months to be exact, and I had this conversation with him just the other day. I was ecstatic to have this conversation with him. And I knew that over the last few years, he had been trading Snap. That's one of the ones I was just talking to you about. I knew he had been trading Snap because he bought Snap on the day of their IPO when the stock was at $24 a share. They opened at 17. In the blink of an eye at the open, they went to $29.44. And before the day was over, they had closed. Before the day was over, this stock had actually closed down around $24 a share. He got in at 24. That's better than having to pay 29, but not nearly as good as 17. And then for the next 5-6 months, he just watched in horror. This wasn't a huge investment. 300 shares at $24 a share wasn't a big, huge investment. But for this individual, it was all he had. He put it all on the line. This was when he contacted me. And his $24 per share investment had dropped all the way. It got a little worse after he contacted me. It got all the way to 11. He had lost over 50% of it. At the time he reached out to me, he was down almost 50%. I think it was down around 13. He had lost $11 a share on a $24 a share investment. And then just a week after that, it was down 50%. And a week after that, it was down more than 50%. Now, we immediately started teaching him how to collar trade, and we got his trade protected. And through this period of time, he made a little money, got a little money back, protected, got a little money back, protected, got a little money back, protected. And then they had an earnings report at the end of January, first part of February of 2018, and they had a nice little jump way to the upside. And he was ecstatic. He's like, okay, I'm getting some of my money back. Didn't get all the way back up to 24 where he got in, but he was getting some of his money back. And he was very pleased with that. And then after this great earnings report where things took off to the upside, all of a sudden for a couple of weeks, it started to drop, looked like it was going to come back a little bit, again, started to drop. And guess what he got right there? All 3 technical indicators suggesting that there was going to be more of a downward trend. And guess what he did? He collar traded this company. He got the long puts in place. He got the short calls in place. And when the stock dropped, got all the way back down under 11 again, lower than it had gotten before, but it started to climb back up. And when he got technical crossovers going the other way, he had enough money from the long puts. Did not have to add anything to his original $7,200. He didn't have to add anything. And short calls had paid for all his long puts up to this. But now he had enough money to add 100 shares to his position. He went from 300 to 400. Guess what happened when he got technical crossovers to the downside again? He got that thing protected in a collar, and it went way down. It got down lower than $5 a share at one point in time. But when he got the technical crossovers, it was back up here around $5.75. He waited for those technical crossovers. He added 500 more shares right here with no added investment. Folks, he went from 300 shares plus 100 made it 400, plus another 5 made it 900 shares. And you know, when the stock got back up to here, look at this, 900 shares. Now by this time, he had been in this trade for a little over 2 years. And he was hating life right here. He'd lost half his money. And even though it hadn't gotten any worse during this period of time, he hadn't made a lot of profit. There was a little bit of profit from some long puts. Hadn't been a lot of profit, but it didn't get any worse than where it was when I met him. And 2 years into this, when he was still $6 per share lower than where he had gotten in, he was 125% profitable. He had taken that $7,200 and made a profit of $9,000 on it. Now it started getting exciting. He added some long puts and he got a little head fake here. He lost a little bit of money here, and he made it back right here and just kind of stayed neutral right here. Saw the thing go back up. And guess what happened just before the COVID-19 thing? Just before the COVID-19 thing hit and everything tailed off, he put a collar trade on it ahead of earnings just in case. Had it collared right up here, got an ugly dip after earnings, and then it started to rebound a little bit, and before it could, the COVID-19 thing hit and it tumbled. But when he got technical crossovers to the upside, guess what he did? He added 400 more shares for no added investment. That's the key to all of this. No added investment. And based on where Snap finished yesterday, look really close at this, folks. This is what we will teach you how to do at Safe Option Strategies. He's been in this trade for a little over 3 years. He suffered through the first 6 months of that, really stressed out about where it was going. I mean, really stressed out about it. And 3 years and 3 months into it, he's up 376%. I've got to wrap up really quickly here because I really have a desire to keep this at an hour. This is what we'll teach you how to do, folks. Again, you can pause the screen and look at the numbers on this. This is one that we sent out to all of our students and traded for a period of about 3 years, and we're over 200% over 3 years. Folks, you know that's an average of about around 70% a year, right around 70% a year. If you're already getting more than 70% a year, nothing, we got nothing for you. If you're not, you better take a close look at what we're doing. Let me wrap this up really quickly. We have a collar trade course and we have a spread trade course. And we've got the numbers to back up that what we are doing works. It is not a get-rich-quick thing by any stretch of the imagination. Compared to other programs, we are quite inexpensive, but I do not claim to have a cheap education program. If you wanted to do the collar trade course only, $1,500 for an annual membership, $2,500 for a lifetime membership. The spread trade course only, $2,000 annual, $3,000 lifetime. Combine them together, $3,000 annual, $5,000 lifetime. But don't turn this off. If you're a little bit sticker shocked, then you haven't looked at other education. And I can't do a lot about that. I know some of you might be looking at this and you were hopeful that I'd get to the end and you'd find out that it was, $100. Sorry. I'm sorry to disappoint you. I told you it's not a cheap program. You want to go out and buy a $100 program, that's what you're going to get. You're going to get a program that's worth $100 and not a penny more. I think ours is worth 10 times what this price is, but I don't believe in charging people that. However, we're running a really nice promotion for the month of July. All you need to do when I end this class in just a few seconds here, all you need to do is scroll down below. You can see this is where you're at right now up here listening to this. All you need to do is scroll down below, fill this out, and hit submit, and you will be redirected to a page that has our July promotional pricing on it, okay? When you get to that page, I would very strongly encourage you, and we're doing a nice discount on all these prices. They're nicely discounted through the month of July, but only for those people who will follow up, have some conversation with us, trade some emails with us. I'm not going to try and talk anybody into this. I am only going to answer your questions. We have a shorter term discount that is going to blow you away on these prices. A lot deeper than just our standard July prices, but it is only reserved for those people who act quickly. If you want to know what the 24-hour discount is, put somewhere in here that you're interested in the 24-hour discount, and I will send you details on that. And I will answer any questions you have. I will spend as much time on the phone with you as you would like. I will trade emails. I'm only going to call if you leave a number. You do not have to leave a phone number. You can make up a name if you want. You have to put a valid email address or we can't send anything to you. You do not have to leave a phone number. You do not have to leave a message. If you put a valid phone number in here, I will call you and I will answer any questions you have. And I will not try and talk you into our program. I will simply answer your questions for you. Nothing more, nothing less. That's all I have a goal to do, is answer your questions for you. Okay? Fill out that form, or you're welcome to call us. We have a toll-free number. And if I don't answer or someone else here doesn't answer right when you call, we will call you back. Folks, I went about a minute over 1 hour. I hope you learned something from this. Let me end with this. I have been making this work for myself and for thousands of people around the country and around the world for over 15 years now. Folks, I know what I'm doing. I know how to teach it. I know how to help you make money. I know that for you to spend a penny with me means that you have to trust me. And that's hard when you've never met me. You've had 1 hour of listening to my voice, and you should be asking yourself, can I trust this guy? I will tell you this. Number one, I'll get on the phone with you or trade you emails, and you can ask me any questions you want to. And I will just be brutally honest with you with my answers. I'll give you as much information as I can. I'll be truthful with you. I will not try to pull the wool over your eyes, and I will not try to talk you into this. I will also tell you this. No one in this industry has a better guarantee than we have. If you decide you're going to step out on a limb and trust us to teach this stuff to you, I guarantee I will help you make the money back that you spend on the program, and I guarantee that I will help you be profitable, or I will give you your money back. And I put that in writing for you, and I honor it. And I can honor it because I can count on one hand the number of times in 15 years that I've had to give someone their money back. And in all of those instances, it had nothing to do with helping them make money. They had a change of heart, or they had a life circumstance that happened. One gentleman lost his spouse a week after getting into this, and I know he was being sincere, and I know he was being truthful, and I didn't ask him any questions. I gave him his money back. Now, that's an extreme scenario, I know. But one person did the program, and they were struggling with it, and I was struggling teaching them. And this is a person who in their field was absolutely brilliant. In stocks and options, they were not brilliant, and they were genuinely having a hard time learning this. And guess what? I couldn't teach it to them. I gave them their money back. Less than 5 times in 15 years has anyone even asked me for their money back. That's why I can give a guarantee like that. I know I can help you be incredibly profitable in the market. I appreciate your time. I genuinely hope that I hear from you. Filling out that form is not obligating you to buy anything from me. It just means that I'll share with you where our discounts are, and I'll make you a really incredible 24-hour offer. The reason I do 24 hours is because I like working with people who are serious, and I'm not a fan of working with people who are indecisive. I will bend over backwards to answer your questions and have conversations with you so that you can get your questions answered in 24 hours. You can do your due diligence in 24 hours. I make a really deep discounted offer because I want to work with people who are serious about this and who are willing to get their questions answered and who are willing to do their due diligence. And to survive in the stock market, you have to be decisive. And if you want 2 or 3 or 4 or 5 or 6 weeks to think about it, that's great. You can take advantage of whatever discount I have going at that time, but you won't get that special 24-hour discount. I hope to hear from you. If not, I wish you nothing but the best. Thanks for joining me on this presentation. Bye-bye.